Well, look, good afternoon. Welcome to this public lecture at the Kuan Yew School. We're very pleased to have Dr. Stephen King, who's going to be talking about his new book, Losing Control, the Emerging Threats to Western Prosperity. I don't want to try and anticipate what will be covered in the lecture, but I guess we're going to be thinking about some of the issues about the emergence of China and India, some of the issues perhaps about the aftermath of the global financial crisis. Let me just say a little bit about Stephen King's background. Currently, he's Group Chief Economist at HSBC, where he covers the global economic scene. He has, over the years, been a columnist for The Independent, one of the UK's leading newspapers. He makes regular appearances on TV and radio. He's testified before the House of Lords Committee in the UK on monetary policy. And in terms of his going back, he studied both economics and philosophy at Oxford University. Now, in addition to giving a warm welcome to Stephen King, I guess in terms of the format for the presentation, we'll follow the standard pattern where perhaps if you could speak for around 40 minutes, and then we'll open the floor to Q&A. I guess this thing is being taped, so when you ask questions, could I ask, number one, you give your name and affiliation, and in the spirit of time being limited, if you could keep your questions sharp and focused. But thank you very much. Thank you.
Well, thank you very much indeed, and thank you, ladies and gentlemen, for coming along today. It's nice to see so many people coming along on a Friday afternoon, which is quite extraordinary. Certainly in the UK, people have gone home probably on a Friday afternoon, so it shows the competitive power of Asia relative to the UK. I thought I would kick off with a few comments about my opening slide. The first one is just an explanation. These very strange hand signals in the bottom right-hand corner are a function of the fact that most PowerPoint devices can't read the HSBC hexagon. It's supposed to be a hexagon, so I apologize in advance if the hand signals are in some sense rude to anyone. They're not intended to be. It's supposed to be something entirely different from what's up there at the moment. Secondly, you'll note that the design of the book is really quite clever. It has a fairly horrific cover, which is entirely, I think, a play on my namesake, the other Stephen King. And of course, what I'm hoping for is that people will see this book in the airport bookshop, think, my gosh, it's the new Stephen King novel. I must buy it. And then they go onto the aeroplane, and after 3 or 4 hours, they discover it's got more about foreign exchange and less about mad axemen than might normally be the case. So I think that might help my sales if it doesn't necessarily help the other Stephen King's sales. What I wanted to talk about today was exactly what's just been described, which is a story about globalization, but a story that perhaps is slightly different from many of the articles and books that you read on globalization, most of which, as far as I can tell, are written very much from a kind of, if you might say, a Western perspective. And there are two Western perspectives, I would suggest, on globalization. The first one is that globalization is entirely good. The second one is that globalization is partially bad. But either way, the Western world emerges as either a relative winner or a winner alongside everybody else. And so the first version of the story, the more positive version, is the idea that the economic success of the West depended on free markets and depended on liberal democracies. And as those kinds of values have spread around other parts of the world, the economic success can simply be transmitted to those other parts of the world. So in other words, the West already is richer, it gets richer over time, but the other countries also get richer over time. Everyone wins, no one loses, everyone's extremely happy. The other alternative view comes from perhaps what you might describe as perhaps a more left-wing view from the West, which is to say that globalization is in some sense a conspiracy from multinationals or from the military-industrial complex or whatever it might be, which is designed to take over resources elsewhere in the world for the benefit of the West, but to the cost of everybody else. It's a kind of exploitation view of globalization. But both of these narratives ultimately depend on the idea the West has the secrets of success. Others can either share in those secrets or lose out from those secrets. But either way, it's still very much a Western story. And the more I thought about this, the more I felt that this story doesn't seem quite right, because the really big changes in the world economy currently are, in effect, the shrinking size of the Western economies in the relative sense, and of course the extraordinary expansion of economies elsewhere in the world, what you might loosely describe as the emerging markets. And my own personal experience of this was about 2 or 3 years ago when I was staying in Shanghai. I go through to Shanghai quite regularly for HSBC business, and when HSBC sends me there, I typically stay at the Grand Hyatt Hotel, which is in the top half of the Jin Mao Tower, which a few years back was the tallest building in Shanghai, and indeed the tallest building in China. And I knew from previous experience that staying in this building gave you a fantastic view from Pudong across to the old Shanghai, across to the Bund. So the best thing to do was to arrive late in the evening, to keep your curtains open, to wake up in the following morning to get this wonderful view across the river over to the rest of Shanghai. So I really did this on this particular occasion. I woke up the next morning, I went to have a shower, I emerged naked, completely wet, walked to the window to admire the view, and was confronted with the sight not of the Bund, but instead of a group of Chinese construction workers. And this was a major surprise to me, because I was on the 85th floor, but they were busily building the World Financial Center, which is right next door to the Jin Mao Tower. And I sincerely hope that none of them saw me, because if they had done, they might have simply dropped off, and that would be the end of them. But nevertheless, this seemed to be sort of, in one sense, an emblem of what had been taking place in China, the pace of building in Pudong, but also a kind of measure of both old China and new China, the Bund, which is on the other side of the river, built by the colonial powers back in the end of the 19th century, the beginning of the 20th century, a sign of success for the British and the Germans and the Americans and the Russians and so on, but in one sense also a sign of relative failure for China at the time. So you can look at, from the Bund across to Pudong and see the success of China in the modern day, but of course equally from Pudong you can see in one sense the old China, the China that was suppressed by the imperial powers back in the 19th century. So it's quite an interesting contrast of the past and perhaps the future for China, and indeed perhaps for relative power around the world. And when I thought about this, it struck me that there were many things that were changing so quickly, we had to think about the world in a slightly different way. Rather than thinking about globalization being a kind of Western process spreading through to other parts of the world, we instead had to think about globalization in the sense that the rest of the world increasingly would affect the West, for either good or bad. And it struck me that as the rest of the world expanded and affected the West, we hadn't really asked all the right questions about what the effects actually would prove to be. So let me offer you a few highlights on this. The first one is this, and I think this is it may not happen, of course, but most people's projections would suggest that China will probably be the biggest economy in the world in 20 or 30 years' time. It won't be the richest economy in the world, of course, because per capita incomes, even with rapid growth, will still be quite depressed compared with those in the States or in Europe. But it'll be the biggest economy in the world. And that's really a remarkable shift in a relatively short space of time. And if I were thinking about this in a historical sense, I regard this as an epic transformation in terms of the shape of the world economy. The reason for saying that is that you could arguably say that China over the last 20 or 30 years has started to correct a kind of error that was made about 500 years ago, which has led to the lack of economic progress in China over hundreds and hundreds of years. And that error goes all the way back to the 1430s. At that time, China had the most powerful navy in the world, commanded by Admiral Zheng He, a particularly tall Mongolian eunuch, to give you the full details of his position. But nevertheless, extremely powerful navy. China was probably the most powerful nation in the world, and this navy was busily exploring many other parts of Asia and possibly even discovered the Americas. People still have a debate about that today. But the Ming Dynasty felt that this navy perhaps was bringing back corrupting influences from elsewhere in the world, decided to destroy the ocean-going fleet, and China became an insular nation. And I think the history of many countries shows that insularity is a terribly bad thing to have. If you haven't got exchange of ideas and technologies with other parts of the world, the risk is that you will effectively stop growing, you won't see the productivity gains coming through that other countries might see. And the consequence is that you just stagnate economically. So whereas in Europe you saw these tremendous gains in per capita incomes beginning to come through, particularly by the time of the Industrial Revolution, the same wasn't true of China. It remained extremely poor. And of course, by the 19th century, and going back to my story about the Bund and so on, by the late 19th century, China, of course, was easy pickings for the imperial powers who abused China in lots of different ways, including the British with their particularly devilish trade in drugs. But the bottom line is that what's happened in China recently is an extraordinary turnaround compared with the past. Two things account for this. The first, I suppose, would be the nationalism under Mao, but perhaps the most important thing is the openness that came through with the reforms of Deng Xiaoping. And the key thing here was that by opening China up to the rest of the world, China was able to benefit from a combination of factors which were incredibly potent for long-term economic growth. The combination, in effect, of remarkably cheap labor with the best quality capital. And this reflects another feature of globalization over the last 20 or 30 years, which is that if you were to define what's really changed about globalization, it's the cross-border movement of capital, which has accelerated at a rate of knots and is totally unprecedented relative to past economic history. The second big change I think is particularly important is simply the relative size of the populations of China and India. We've had examples of economic catch-up in the past where countries have seen rapid per capita income gains, most obviously Japan and South Korea over the course of the last 50 or 60 years. But the key difference is, of course, that the combined population of Japan and South Korea is about 200 million, whereas the combined populations of China and India are 10 times bigger, 2 billion. The consequence, therefore, is that if China and India really do begin to catch up with the rest of the world, their growth and their demands for various resources will have an impact not just domestically within their own economies, but huge spillover effects into other parts of the world on the scale that Japan and South Korea couldn't possibly have delivered. And so those spillover effects, I think, are going to be particularly important in the years ahead, and which have the potential to create both winners and losers in other parts of the world in the years ahead. Third key point, the developed world's share of the world's population of working age. Back in the 1950s, the developed world's share of the world's population of working age was about 1/3 of the total. And of course, these were the most educated, the most skilled people in the world, so they had a lion's share of labor incomes. By 2050, 100 years forward from 1950, the share will be down to about 12% or so, according to the latest United Nations projections. That's a remarkable decline in a relatively short space of time, and it reflects a couple of things. The first one is, of course, the aging of societies in the West, the fact that we're seeing more people in retirement and fewer people actually in work. And the second thing is a really big change. It's already happened in Asia, but has the potential to happen maybe in sub-Saharan Africa and in other parts of the world, is increasing life expectancy. If you look at, for example, East Asia back in the 1950s, life expectancy was only about 44 or 45. Very similar, in fact, to where it is in sub-Saharan Africa today. And what you can see from Asia's experience, actually, is that as you start to see rising life expectancy, you end up with a kind of virtuous circle being developed. And the virtuous circle partly reflects the fact that if you expect to live a little bit longer, you have a much stronger incentive to invest in education. And of course, if you invest in education, then the productivity and the skills of the workers begins to increase, and they become increasingly more competitive. So the competitiveness of Asia over the last 50 or 60 years is partly associated with rising life expectancy, improvements in numeracy and literacy, which effectively made Asia more competitive over time. Combine that with the greater geographical mobility of capital, it's much easier to explain why Asia has done so well. But it may also be an explanation for why other parts of the emerging world could do well in the years ahead. The consequence of these changes, I think, is that you end up with a series of what you might describe as relative price shifts. And there are two particular things I'd like to focus on here. The first one is the way in which demand for the world's raw materials will come through in the years ahead. We think we know, not certainly, but we think we know from the experience of Japan and South Korea that while per capita incomes remain below, say, about $14,000 a year, the income elasticity of demand for raw materials is incredibly high. In other words, countries with those low per capita incomes tend to have a disproportionate increase in demand for commodities and raw materials as their economies expand. China currently has incomes per capita of about $2,000 or $3,000 a head. India's is significantly lower. So these countries really are expanding. If their per capita incomes genuinely are catching up with those in the rest of the world, the chances are we're going to see a tremendous global increase in the demand for commodities. A simple back-of-the-envelope calculation would suggest that by 2030, 2035, China will be attempting to consume the equivalent of all of today's global oil production. Now, clearly that's not going to happen. Maybe we get lucky, new technology comes through, we replace fossil fuels, or more likely the new technology only comes about because the price of fossil fuels themselves goes up so much in the near term. So we've been used to, for many years, particularly in the West, the idea of very easy access to raw materials and raw materials prices continuously coming down. And when they went up, 200 or 300 years ago, the West simply found raw materials somewhere else by colonizing or invading another country. But this time around, the West doesn't have those opportunities, and life would become much more difficult, I think, in circumstances where demand for commodities comes through from China, India, and the like. And the other big change is competition in the world's labor markets. The way I think about this is to go back to this idea of the mobility of capital. If you look at capital mobility relative to the size of global GDP, it reached a peak back in 1914. Of course, it then collapsed largely because of the First World War and all the isolationist policies that came through in the interwar period and, of course, the Second World War as well. And we didn't really return to the ratios that we saw in 1914 until about 1980. So for much of the 20th century, capital did not flow across borders. And what that meant was that the good quality capital effectively remained in the West. Western workers, if you like, had a monopoly access to global capital. And I would like to argue that because of that monopoly access, they kind of extracted economic rents. And they earned more than they actually deserved to earn in a properly competitive global marketplace. And the consequence of capital becoming increasingly mobile, those workers no longer can easily earn the economic rents. And the consequences of that, downward pressure on wages themselves, upward pressure on long-term unemployment, which is possibly a theme for the US currently, and of course a tremendous attack on the pension rights of Western workers over the course of the last few years. So what we have, in effect, is the emergence of new powerhouses in the global economy, which cause relative price effects, which in turn have the potential, at least, to deliver both winners and losers. These observations also, I think, are related to a couple of paradoxes of globalization, which may not be economically important, perhaps, but are certainly politically important. The first of these is that globalization has certainly helped to reduce income and wealth inequality between nations. So China and India slowly catch up with living standards that already exist in the States or in Europe. But at the same time, it seems to increase income inequality within nations. If you're an owner of capital in the US, you've probably done pretty well over the course of the last few years. If you're a worker in the manufacturing industry, perhaps you've done relatively badly. Even for people who are university graduates in the US, this effect has come through because academic studies have suggested that over the course of the last 20 or 30 years, productivity growth for university graduates has massively exceeded the gains that have come through in their wages. So there have been winners and losers from this particular process over the course of the last few years. The second aspect or second paradox, if you like, is that we have both more and at the same time less globalization over the last 100 years. More because of the capital flows story I've already pointed to, and less in two different ways. The first way, which is not mentioned on this slide, is the reduction in cross-border migration of people relative to the size of indigenous populations. In the 19th century, many economies grew because they can get access to workers from elsewhere in the world. If you look at the US, well, the big secret of the US up until 1820, of course, was slavery. That was the main explanation for the massive growth of the US population until that point. And between 1820 and 1900, of course, it was mostly people coming in from Europe. But the 20th century saw effectively the arrival of border controls and the invention of the passport. I declare an interest here because it's actually the British who invented passports first of all, although I understand that the original British passports, oddly enough, were written in French, which is a slightly bizarre result. But nevertheless, the movement of people across borders has gradually reduced over time. And the other thing that's happened is the arrival of the nation state. Now, one of the advantages of empire, and I'm not going to list a long series of advantages of empire because there aren't many advantages, but one potential advantage of empire was if you have a relatively global capital market, it was also a capital market that was relatively easy to regulate and to enforce legally because you had an empire whereby the structures were very similar around the whole world, and that's absolutely fine. But of course, these days we have many more nation states. Back in 1900, there were about 50 nation states. Now there are about 200 or so. I argue that actually has created difficulties in thinking about how to manage global capital flows. Difficulties have become very obvious over the course of the last 2 or 3 years. And these paradoxes give rise to a number of difficulties. In the West, there are a couple of problems that have been created. The first is that in thinking about income inequality, the effects of it have actually been masked, particularly in the US. Because although you have income inequality, which has grown rapidly, consumption inequality has not grown rapidly. And the reason for that is that many people who haven't seen particularly big increases of wages have still been able to consume very easily because of increases in debt. And actually, one of the reasons why debt has gone up quite a long way in America is because it's been relatively easy to borrow because other countries, of course, have been saving quite a lot. We come back to the global savings glut story. But I think the important part about this story is that, of course, the savers around the world tend to have a very skewed demand for certain kinds of assets. So the Chinese, for example, tend to buy a lot of treasuries and agencies. And here you end up with a dispute as to why they're doing this. The Americans would say it's all to do with cheating and undervaluing the renminbi and trying to get a mercantilist trade policy coming through. The Chinese might well say, well, look, we're buying treasuries and agencies, but only because we have to run a current account surplus, because we've got a lack of significant reform on social security, we've got a lack of reform coming through in consumer credit, and therefore we can't help but run relatively high levels of savings. But the reason we buy treasuries and agencies is frankly because you, the Americans, won't let us buy anything else. We tried to buy Unical, and you said no, and that gave us an indication that we shouldn't be buying any American companies. But the consequence, whatever the cause is of this, is that demand for treasuries has been incredibly high. The yields have year in, year out been incredibly low. And the consequence has been that many investors around the world, frustrated with these very low yields, have hunted for other kinds of assets to invest in. Now, back in the 1990s, it was equities until the TMT bubble burst. And of course, more recently, the assets of choice were all these exciting, wonderful things called mortgage-backed securities and collateralized debt obligations and so on, which have all led to some fairly well-publicized difficulties in the US and elsewhere over the course of the last few years. So the addiction to debt to cover up the income inequality has in one sense created additional or different types of problems associated with financial instability. And this is also reflected externally, as I mentioned before, because of the fact that we have one global capital market, but at the same time a series of different regulatory, supervisory, financial, and legal systems. And of course, one of the problems that's been created during the financial crisis is the inability of countries to agree with each other as to how the world capital market system should actually look. And I'll come back to some of the dangers associated with that a little later in the talk. Bottom line from all of this is that the West, I think, is in some sense losing control of its economic destiny. And of course, it's possible that the West was always deluded by the idea it had control of its economic destiny. And certainly there are plenty of policymakers who probably suffer from these delusions from time to time. But I think that if I can be more precise about this, there are losses of control both from a short-term perspective, looking at the standard macroeconomic variables, and there are also losses of control from a long-term perspective. I'll try to highlight each of these in turn. The first of these short-term implications is associated with trade. We just had a change of government in the UK, and the new government, led by David Cameron, been talking about the importance of selling exports to China. The idea here, of course, is that if we can export more to China, and China is growing very, very quickly, then China will help to push the UK economy upwards and will do better as a result of these exports to China. So I thought I'd look at the strength of this argument and have a look at the countries in the developed world who've been particularly successful at exporting to China over the last 20 years or so. I looked at across the G7 countries. I discovered it wasn't the US that had been particularly successful, nor was it Germany, or the UK, or France, or Italy, or Canada. And by default, of course, you can now guess that the country which has been really successful at exporting to China is Japan. which is slightly odd because Japan's been stagnant over the course of the last 20 years. So if there was a kind of relationship between the strength of exports to China and the performance of the domestic economy, it doesn't seem to have worked particularly well in Japan's case. You might well say, well, Japan's had lots of other problems to confront, and that's why Japan's been pretty weak. But I would argue that actually part of Japan's problem has been precisely the arrival of China on the economic scene. That combined with the flow of capital that now takes place across borders. Because when you look at the exports from Japan to China, you find that the vast bulk of these exports, the way they've been increasing over time, are exports of capital goods. We look to see which particular companies are involved in the export of these capital goods to China, or shall I say, which companies are involved in the import of these capital goods into China. Well, many of the companies are actually Japanese multinationals. And of course, what they're doing is closing down their domestic Japanese suppliers and opening up new suppliers in China who happen to have much lower labor costs. So it makes sense to shift the capital across from one part of the world to the other to boost the multinationals' profits. But it doesn't necessarily mean that the multinationals' profits being boosted is necessarily good news for Japan itself. And what you have in Japan over the last 20 years is a kind of process of hollowing out, that industry has moved away from Japan increasingly to China. Now, you might say, well, the fact that Japan hasn't coped with this very well simply indicates a lack of flexibility in its economy, that the US and the UK have had similar problems in manufacturing, and manufacturing has shrunk over many, many years, but the US and the UK have done much better than Japan because they found other industries in which to invest, of which the shining light of these other industries was, of course, financial services, which was a shining light until about 3 or 4 years ago, and now it seems to be, of course, a beacon of instability in the Western world. And this comes on to my second point about capital market booms and busts. This refers back to my earlier comments about Chinese savings behavior. I should suggest it strongly emphasize it's not just China, of course, that's doing this. Russia and Saudi Arabia, and of course you could always also put in some developed nations as well, like Japan and Germany, running large current account surpluses. But the point about this is that we tend to believe, certainly in the West, that capital markets are made up of lots and lots of small players, and the market actually works because there are so many both buyers and sellers within the market, and therefore it's almost like perfect competition. But increasingly, if you think about it, the biggest lenders in the world are increasingly nation states in the form of rapidly rising foreign exchange reserves in China and elsewhere. And increasingly, of course, the biggest borrower in the world is the US, and more recently, it's the US government. So in one sense, you might say, well, actually, it's no longer clear that we do have a proper and free global capital market because the biggest players are governments and not so much the private sector. And we've seen over the course of the last few years that booms and busts can come through more regularly, partly because of the distortions associated with this kind of savings behavior over the course of the last 10 years, the boom in housing and securitization and the subsequent reversals that have come through. And the third short-term implication relates to inflation. I find it very odd that central banks haven't really developed their arguments very much over the course of the last 2 or 3 years, because in one sense they really should have done. The kind of conventional wisdom in recent times has, of course, been that if you can achieve price stability, then your reward will be economic stability as well. The two supposedly go hand in hand. And you can see why people believe that, because, of course, it's a reflection of the experiences of the 1970s. And the current crop of central bankers in charge mostly would have had their formative experiences in the 1970s. You can see exactly why they fear inflation. But even before the latest crisis, I thought this was slightly odd, because if you went back further in history, you'd find plenty of examples of economic instability associated with low inflation rather than high inflation. A very recent example, of course, is Japan, relatively low inflation in the late 1980s, a complete mess thereafter. But the best example of all, frankly, is the late 1920s in the US, where inflation was remarkably low. But yet we ended up with the crash and the Great Depression that followed. I think the problem today with inflation is that increasingly inflation in the West follows a random walk, which has very little to do with Western monetary policy. It's a random walk because there are a series of ongoing shocks coming through from relative price shifts taking place from wages and commodity prices originating from demands coming through in the emerging world. And it's very difficult to predict from one year to the next whether inflation is going to be a little bit on the high side or it's going to be a little bit on the low side. But if for every upside surprise in inflation and every downside surprise for inflation, there's a monetary response, when actually the surprises on inflation have nothing to do with monetary policy, you're going to actually bring instability into your economy. And going back over the last few years, one might argue that central bankers, particularly earlier in this decade, were too fond of the idea that they believed that the so-called Great Moderation was the result of their own remarkable skills, rather than simply a matter of luck and timing associated with outsourcing and offshoring coming through to China, India, and elsewhere. And the failure to see the global picture, I think, contributed to monetary policy remaining too loose for too long. So although inflation itself remained stable, imbalances within the economy has got bigger and bigger and bigger. So the failure to understand the effect on the West of inflationary shocks coming through from other parts of the world, I think directly contributed to the instability that we've seen over the last few years. Now, I want to move on to longer-term implications. I mentioned the income inequality issue already. This is something that's going to become a big political issue. In the US, up until 3 or 4 years ago, as long as you can get access to consumer credit, income inequality didn't matter too much. But we're now in the world of deleveraging rather than leveraging, if I can call it that. It's a remarkable turn of events compared with the experience of the last 4 or 5 decades. And deleveraging, in one sense, is beginning to reveal the full force of the income inequality it's been building over many, many years. You can see it in lots of different ways. The massive increase in US long-term unemployment, the increased anxiety being expressed about immigration in places like Arizona. The sense, perhaps, that the US should be thinking not just about its own fundamental weaknesses, but also thinking politically it's quite convenient to blame somebody else for America's problems. And so one big danger that stems from this income inequality is that rather than fixing problems at home, the US will increasingly blame countries abroad, which relates to, of course, exchange rate policy. It also relates to the possibility of protectionism beginning to come through in the years ahead. The second long-term implication is the nature of capitalism itself, and what I would describe as the return of state capitalism. Notice that I use the word return rather than the emergence or the arrival of state capitalism, because when you think about the model that perhaps China is considering when it comes to investments in sub-Saharan Africa, when you think about the model that perhaps Russia is thinking about in terms of its energy supply activities with Europe and Asia through Gazprom, actually these are quite good examples of the behavior of Western economies, not perhaps in the 20th century, but certainly in the 18th and 19th centuries, when, of course, countries were much poorer than they are today. And you can see why this might be happening, because if you can make projections about demands for energy in the future, and you're not convinced that every other country will allow the free market to work, maybe you should intervene yourself to support your national interests without necessarily worrying too much about the global consequences of supporting your national interests. And so Gazprom is a very good example of this. Gazprom has built pipelines into, or is building pipelines into Germany, into Italy. It means that it can directly supply Ukraine without the Ukraine then supplying the gas onwards to Europe. And effectively, it's a divide and rule strategy. It divides Germany from Italy within the European Union. And also, of course, it means that Russia regains some degree of influence over the Ukraine. The same might be also happening to the east of, or the south of Russia as well. The point is that Gazprom is an agent of the Russian state, arguably, 51% owned by the Russian state. And importantly, a few years back, the head of Gazprom was one Dmitry Medvedev, who happens now to be the Russian president. So there are lots of connections there. But of course, the lesson here is, going back in history, that the success of Britain, of other European nations in the 18th and 19th centuries, didn't really depend on free markets and liberal democracies. It depended much more on the exercise of state capitalism, the blurring of commercial and national interests in terms of the pursuit of policies around the world. And of course, one of the greatest examples of this is the British East India Company, which got up to all sorts of dodgy activities. India became part of the British Empire largely because of the commercial interests of the British East India Company. The British East India Company was directly involved in the aforementioned selling of drugs to the Chinese, and arguably also the British East India Company, by contributing to the rigging of the international tea market in the late 1700s, contributed to the Boston Tea Party and the loss of the American colonies. So this connection between state and commercial interests is a very, very long history. I think it's likely to be coming back in one way or another. So effectively, it reflects the idea that states will want to exert their own influence on global economic conditions above and beyond what the free market could possibly deliver. And the final long-term implication is the recognition that I think the West has to make with its aging populations and with the growth of youthful populations elsewhere in the world, that increasingly the West will become dependent on the emerging world, whether it likes it or not. If rich Americans and Brits and French people want to go down to Florida or go to Cannes or Nice and have these very pleasant holidays from time to time when they're in retirement, someone's going to be doing something to support them in their retirement. And the question is, who will that be? Well, there are some various options here. The first one, of course, is that people in the West will simply have to work harder, longer working hours per week, fewer holidays per year, older retirement ages. All these things have been discussed. A second alternative is to follow the Japanese or the German model, run a current account surplus and export your savings to other parts of the world, to invest where the youthful populations are. But the problem there is that actually these countries have not done a particularly good job of it. In Germany, for example, you might have said, well, Germany, aging population, it would make sense for Germans to invest in parts of the emerging world where they can bank on getting access to youthful workers in the future. But Germany didn't do that. It instead invested in some really excellent assets in nice, safe Western nations. It invested hugely in mortgage-backed securities in the US. And of course, it's also invested hugely in Greek government debt. So it's made some excellent choices over the course of the last few years. And the third option, which is one that the US was pursuing until recently, one that the Europeans have been mostly against over the last few years, is simply to open the borders, to get rid of all those passports and get rid of all those border controls and actually allow for more immigration. If you can't sell democracy to the rest of the world, you can bring the rest of the world to your democracy. You might say that actually has some positive implications. But interesting enough, just at the point when perhaps the West should be thinking about that kind of policy, it's precisely the point when the West seems to be rejecting that policy. Now, I talked about the West in general. I wanted to focus now specifically on the US, because, of course, this clash I'm talking about, this loss of control, is a loss of control that in many ways European nations have experienced for many years. If you told an Edwardian English gentleman back in, say, 1905, that although the UK had become richer, it would lose the entirety of its empire over the course of the next 100 years, I think he'd be absolutely horrified. I think that many people in America may not have quite the same view as the Edwardian gentleman, but would expect to be top dog for many years to come. I'm not convinced it necessarily will happen. And the reason for this is that the US has been misbehaving in a number of different ways associated with which you might describe as the abuse of its reserve currency status. And the first comparison I'd like to make is to suggest that the US has been behaving a little bit like the behavior of Catholic priests. Now, I stress that I'm not talking about the recent behavior of certain Catholic priests, allegedly. I'm thinking about Catholic priests back in the 14th and 15th centuries, when they were selling indulgences. Indulgences were pieces of paper, in effect, which were promises of a happy life in the hereafter in exchange for a large amount of money, so that the Catholic priests could build their churches and cathedrals and so on and so forth. The problem, of course, was that the priests had no right to make this promise. I have no idea whether people had a happy life in the hereafter, but I do know that the priests had no right to make the promise. And eventually it was recognized as a scam. And of course, this is part of the reason why you ended up with the Protestant Reformation. That there was a sense of endemic corruption within the Catholic Church at the time. I would like to argue that the US today is doing the equivalent of the sale of indulgences by selling treasuries to the rest of the world. Now, the act of faith is slightly different. The act of faith isn't an act of faith in the hereafter. It's an act of faith about what might happen in terms of the ability of US taxpayers to repay those debts at some point in the future. What I'd like to argue is that I suspect, ultimately, that US taxpayers have no intention of repaying their creditors. I'm not suggesting that the US is about to default to its foreign creditors. I'm suggesting instead that the US will use its reserve currency to find a way out of this conundrum. And the way out of it, of course, is that if you can devalue quite a long way, you effectively shift the burden of problems away from domestic debtors towards foreign creditors, because the foreign creditors in America's case have lent to the US in dollars, so the dollar goes down, the renminbi or the ruble value of those dollar assets falls. So the foreign creditor basically is worse off, and therefore there's been, in effect, some kind of default. Now, the tricky thing with this is that although in theory it works, it also leads to longer-term problems for the US itself. And this is associated with another historical example, this time 16th century Spain. Spain, back in the 16th century, discovered the equivalent of a printing press. It was actually the supplier of the world's reserve currency, because back then the reserve currency was not dollars, it was silver. The Spanish had silver by the bucket load because, of course, they had sent their conquistadors over to Mexico and Bolivia and so on. That's where all the silver mines were. So the Spanish got the silver and shipped it across the Atlantic and then spent the money in Europe. As it turned out, of course, not all the silver got across the Atlantic because the English, with Sir Francis Drake, for example, were busily stealing the stuff off the Spanish. Of course, the Spanish regard Sir Francis Drake as a pirate, where, of course, in Britain we think of him as a national hero, but different perspectives in this particular story. But nevertheless, the silver came across to Europe, and the Spanish sat there and spent the money, and they sat there really enjoying rather a good life. Not all of them did, I stress, because the Inquisition was going on at the time, but many of them did have a pretty good life. And in effect, in sort of modern day terms, what was happening was that the Spanish were running a balance of payments current account deficit, which was being funded through the issuance of silver, which was being willingly held in the form of, I suppose, foreign exchange reserves, if you like, by other countries elsewhere in Europe. But this created two problems. The first one, obviously, is that if you continuously increase the supply of silver, eventually the value of silver goes down, which would be the equivalent to saying the dollar's value would fall. The second problem was this, that because Spain ultimately was just digging up silver and giving the silver to other people, encouraging other people to make things for Spain, those other people, over time, became better and better at making things. They acquired skills, they acquired technologies and productivity gains that didn't seem particularly plausible at the beginning of the 16th century. But as they acquired these skills, they became economically, politically, and militarily stronger and stronger and stronger. So by the end of the 16th century, Spain falls to defeat over land in the wars with the Dutch, and falls to defeat against the English at sea with the defeat of the Spanish Armada. Of course, the Spanish still blamed the bad weather for the defeat of the Armada, where, of course, the English like to claim its superiority of military strategies and so on and so forth. But bottom line is that Spain was a shadow of its former self by the end of the 16th century and didn't really recover until much more recently, about 4 or 5 weeks ago, when they won the World Cup. But the key thing about this is that, in many ways, Spain's story is actually, in one sense, a story for the US for the 21st century, because if you continuously abuse the reserve currency and you rely on other people to make things for you, and you run a continuous current account deficit, what you're doing is changing the relative skills and abilities of people in different parts of the world. And the big winners from this, the equivalents of, if you like, Holland or England back in the 16th century, are, of course, countries like China and India today. So this is a huge shift in the balance of power, arguably because the Americans, like the Spanish before them, have tried continuously to live beyond their means and have exploited their reserve currency status to do so. Now, what are the longer-term implications of this? Well, one obvious implication is that the dollar begins to lose its reserve currency status, and people have talked about this for many years, and it hasn't really happened as yet, but I think that over time it may happen, for one simple reason, that those people who are willing to hold dollars may begin to shift. In particular, as the US and Europe shrink in relative terms in the world economy, there'll be the possibility of thinking about new reserve currencies. I'm not suggesting that the Americans or the Europeans would ever think about the renminbi as a reserve currency, but as China's trade with the rest of Asia, with sub-Saharan Africa and Latin America expands rapidly in the future, there's a very good chance that those countries might well think about the renminbi or some other kind of Asian currency as an alternative to the dollar as a reserve currency, maybe in 20, 30, 40 years' time. So I think the tectonic plates are shifting, and the Spanish example tells you that major changes in power as a consequence of these shifts in tectonic plates. That gives a few choices for the future, the good, the bad, and the ugly. The first one, the good one, is funny enough, is the euro. And I was rather criticized for this view earlier in the year, because I wrote this view and it was published just at the time when the whole Greek crisis came through, so it was rather unfortunate timing. But what I do think is good about the euro is it recognizes something, one of these paradoxes about the global economic system, the paradox of lots of nation states alongside a global capital market. A global capital market is an advantage. It's certainly helped to lift many people out of poverty over the course of the last 20 or 30 years, but it's difficult to manage. If you can pool your monetary and financial sovereignty into a kind of club, then maybe it becomes easier to manage. They can get some unruly club members, and club members can misbehave from time to time. But if the club creates a dialogue which actually tries to stamp out that misbehavior over a long period of time, maybe these kinds of pooled sovereign arrangements can actually work rather well. But certainly, in my view, a lot better than the alternative pooled sovereign arrangement, which would be the return of empire, which is another way of dealing with the same problem. The second choice is, well, really the return of 19th century great power rivalries, the sense that the US, China, Russia, parts of Europe will be competing for the same scarce resources. If it really is the case that we're going to see tremendous demands for commodities coming through and commodity prices continuously rising, there's going to be a real battle for resources, which will become, I think, increasingly political. It can't be left to the market. We've got some very good examples of this currently. The whole issue about wheat, for example, is an example of this kind of return of state power in influencing the allocation of resources around the world. And the ugly option is effectively a return of the isolationism of the first half of the 20th century. And the reason for mentioning this is that at the beginning of the 20th century, certainly in Britain, there was a very strong view that globalization was one-way traffic. It couldn't possibly go into reverse because everyone benefited from it. And it turned out that it could go into reverse through the First World War and the gradual isolationism that came through in the first half of the 20th century. And the point about this is that if you genuinely do have both winners and losers, the losers can end up with the political upper hand. They can reject globalization, perhaps on the basis of a short-term strategy, but everyone moves in that particular direction. Everyone ultimately loses out, as we saw in the first half of the 20th century. The point here is that globalization is not one-way traffic because politicians and political movements can prevent it from being one-way traffic. Even if economically it makes sense, it doesn't always politically make sense. There aren't always votes in it over the last few hundred years. And that finally leads me to the Western dilemma. The first choice is for the West to grow old gracefully, to accept that its place in the economic sun is over, to accept that political, economic, military power is shifting to other parts of the world, and simply to accept that ultimately, as its power diminishes, it will have to listen increasingly to countries in this part of the world, to countries in Latin America and elsewhere, and to have to accept that they have a right to have their views expressed. And perhaps the West can do that. It would be a very mature approach. Perhaps it can happen. The alternative is to reject globalization, to say we don't like what's happening, we never expected all these things to be happening, we didn't expect these relative price shifts to happen, we didn't expect to see winners and losers, we didn't expect to see higher income inequality, we thought what would happen is that our model would spread everywhere else and everyone would be better off. And now we discovered that isn't quite the truth. We're now going to reject globalization. If that were to happen, I think it would be a disaster for the West, a disaster for the rest of the world as well, but ultimately be a bigger disaster for the West, because I think ultimately if that were to happen, you would see the growth of trade across the emerging world, the so-called South-South trade, growth of capital flows in these different parts of the world, and the West would become even more weaker, softer, more pathetic over the course of the years ahead. So there's some choices, one which is not particularly attractive, but the other of which is a hell of a lot worse. On that note, I'd like to thank you very much for your attention. Thank you very much indeed.
Well, thank you very much for a very interesting tour de force in terms of some of the possible alternative scenarios for the global economy. Maybe we'll discover one day if there is life after debt. Let me begin with one question and then throw things over. There's much discussion about the rise of East, the rise of the emerging markets, the rise of Asia. We appropriately focus on the challenges that countries like the US, countries in Europe face. I'm wondering if we are not paying as much attention as we should to the challenges that countries like China are facing in terms of internal inequality, in terms of their development. And I mean, one thing we've surely learned from the World Bank's projections in the 1960s that the Philippines and Burma would be the leading countries in Asia. One thing we've learned is that linear extrapolation on globalization or whatever is sometimes very premature. So I'm wondering if you could talk a little bit about how you see the Asian response and how you view this uphill movement of capital. does it make sense for China to put 2.5 trillion or so into low-yielding treasury securities? What's the view of the world behind this? I think it's more than just China's not allowed to invest in real assets. So I'm wondering how you see the challenges from the Asia side, because in short, I would think that there are a huge number of challenges that China has to face.
All very good questions in the sense that they're tricky questions, and therefore I have to try and answer them sensibly. First of all, I agree about the linear extrapolation issue. In a former life, I used to have to be a so-called expert, I use that in inverted commas, on the Japanese economy. And I started covering Japan in 1990, which is about the worst possible year to start covering Japan, because we all knew in 1990 that the Japanese model worked. We all knew in 1990 that a small fall in equity prices would be a very good thing, because it would prick the bubble, take out the excess in Japan, allow Japan to carry on growing at 4 or 5% a year. As it turned out, that was a view that was completely, utterly wrong. I would, though, like to point to a difference between Japan and China. It's not admittedly a difference between necessarily China and the Philippines. But I think one key difference is this, that Japan did grow extremely rapidly for many, many years. Its per capita incomes did rise extremely rapidly. And by the end of the 1980s, Japan had reached income per capita levels which were probably best in class globally. In fact, one of my first trips to Tokyo, I was taken by one of my colleagues to the Palace Hotel, to the bar there where you could buy a steak sandwich. The steak sandwich at the time cost £35, so I guess that's a bit more than 70 Sing dollars, which struck me at the time as being rather expensive. It suggested there was something rather out of whack as far as the real exchange rate was concerned. However, I think one big difference here is that whereas Japan had become best in class, or maybe excessive best in class by the late 1980s, China's per capita incomes are still, of course, extremely depressed. So although many people have come out of poverty, the average is still very, very low. I also think that the China story is developing quickly, in part because there is effectively a mutually beneficial arrangement between what you might describe as Chinese workers and Western capital, in the sense that part of the story of China is not that China is running things, but rather that Western capital, in part, is running things in China. So it's the skills of management, the skills of running factories and so on that come from the West or from Japan, which have gone into China over the last few years. So the number of multinationals operating in China, foreign multinationals, is absolutely enormous. And that may also help to safeguard some of the improvements coming through in China over time. As for the income inequality story, absolutely. If you look at the numbers for income inequality, China, this is ironic really, has about the same income inequality as the US, given the differences in political systems. There is a bit of a peculiarity. But I would argue that in China's case, this is a kind of normal part of the process, that countries going through this process of economic catch-up typically do find themselves going through a period of tremendous income inequality. You only have to read Dickens to realize that this was a key feature of the UK in its industrial revolution in the 19th century. The question, I guess, in China is, can you cope politically with that level of inequality? Can you continue to dangle a carrot in front of those people who are still on very low rural incomes, making them the promise that at the time they too will have the opportunity to share in China's newfound wealth? And I fully accept that's going to be a difficult challenge to deal with in the years ahead. I think also it's worth stressing that when I discuss this issue of state capitalism, I may have portrayed this as a sort of West versus East story or West versus emerging market story. But of course, state capitalism applies within the emerging world itself. And food is a very good example of this, that within the emerging world, you have food-producing nations on a net basis, so they're net exporters. You've got food-consuming nations. And when we saw the last food crisis back in 07, 08, it was clear that elements of state capitalism began to come through, that exports were banned, that production was designed for domestic rather than foreign consumption. The domestic price was lower than the global price, which was designed to protect domestic consumers. But the consequence was that the market signals that should have led to more food production didn't really materialize. And so you ended up with food wars coming through between these different nations within the emerging world. And of course, the reason why it's particularly important for the emerging world is that people on low incomes food prices, energy prices have a huge impact in terms of their spending on a monthly basis. So the politics of this are actually much more difficult. So I think those are a few responses that I offer to that particular question.
Thanks. Can I throw open to questions from the floor? Can you give your name and keep your answers, your questions, sorry, short and symmetrical responsibility. Two at the back.
Hi, my name is Karthik. I'm in the MPP program here, the first year. Do you think a possible solution, as far as your last slide goes, is a reduction, the West accepting a reduction in the standard of living that it's currently enjoying? Do you think that could potentially make it easier for the West to actually choose option one and be more like the East and age gracefully?
The simple answer is no. I think that it would be incredibly difficult for the West to accept that somehow its incomes have to come down to make room for people elsewhere in the world. And this is a huge difficulty. You can see it in a number of different areas. You can see it in terms of the negotiations on trade. The collapse of the Uruguay round is partly a response to these differences of view as to exactly who should make sacrifices to make the world trade system work a little bit better. You can see it in Copenhagen with the climate change discussions. Global warming, yes, at the margin is being caused by Chinese and Indian success. But the absolute amount of emissions, of course, is mostly the responsibility of America. So is it the marginal change or the absolute amount that matters in terms of what takes place? And if America tells the Chinese and the Indians not to pollute quite so much, doesn't mean you're effectively trying to restrict their economic well-being simply to protect your well-being. I mean, I was walking around in New York recently, and it's quite bizarre. You have hotels where you've got flamethrower lights outside which burn throughout the day just trying to warm up the little bit outside. I think this is just an extraordinary waste of energy. It's absolutely unnecessary, but until you actually start to see a crimping on the American side, very difficult to see how you're going to get agreement coming through. The hope, of course, would be that productivity gains and technology gains will dig us out of this particular conundrum. And to be fair, that's exactly what's happened in the past, that we've seen a combination of these productivity gains, and of course in the 18th and 19th centuries, land grabs and slavery and other bits and pieces which alleviated the pressures on the West. But I think the tricky thing at the moment is something I refer to in the book, which is the notion of what I call technology replication rather than technology improvement. Much of the growth we see in the world today is not because of improving technologies, it's that the same technologies are being replicated time and time again. So as an example, air travel has become much more efficient over the last 50 years, but the number of people traveling has gone up much faster. So although the efficiency has improved, the actual demand has gone up greater, so the actual resources being used are higher now than was the case previously, even if the resources per passenger mile have gone down.
I'm Bastian. I'm a student at the MPA here. I'm a citizen from the Netherlands, although for the last years I've been an Asian. But I like to return to Europe, but I'm a little bit worried now. So how will the life look like for my children or my grandchildren if we choose either to grow old gracefully or if we're going to reject globalization? How will life change?
My recommendation would be to stay in Singapore. That would be the easiest choice to make, I'd have thought. Any other choice is going to be suboptimal, so don't think about it. No, in all seriousness, I think there are some difficulties. If I think about my own children, I've got a 17-year-old who's about to go to university. And when I went to university and thought about job prospects afterwards, I knew I was competing with other people in Britain for jobs, but didn't really give a second thought about competition from people elsewhere in the world because there weren't many competitors at that time. But now, of course, companies recruit from all over the world, and indeed universities recruit from all over the world. So the competitive landscape has changed quite significantly. I also think that in Europe, there is still a kind of lack of recognition of the extent to which social security systems are becoming incredibly expensive, that as populations age, the revenue growth to support those systems won't really be there, and there'll have to be some very difficult choices in the years ahead about whether people have to retire much later, whether they work harder, whether their tax burden goes up, or whether you start seeing the kinds of supply-side reforms that remove some of the kind of the comforts that have been provided to Europeans over the course of the last few years. So I think it'll become quite a lot tougher in the years ahead. And in one sense, you might describe the generation that is in their, say, their 40s through to their 70s for Europe as being a kind of lucky generation, a very fortunate situation developing over a number of years. Even if GDP rises in Europe in the years ahead, it may be that the terms of trade in one sense deteriorate, so although you're working harder and producing more, it may not be the case that actually incomes and sales will rise particularly quickly. So I would stay here. It's warm.
Question here.
My name is Michael Heng from East Asia Institute here. In your book, I read through your whole book. I'm very impressed. In your book, you mentioned the whole idea of the rentier sort of economy in the West. In fact, I was very happy that you mentioned it in your talk. And this is related to the first question here about whether the West could respond by, our friend here mentioned a lower standard of living, I would say a lower cost of living. Because if the West had been enjoying such a, what they call high cost living, or I'd rather use the term high cost living rather than high standard of living because of the rentier behavior. So would the economy changes in the world not force the West, whether they like it or not, to respond in a way that they will have a lower cost of living? And another thing that's related to it is, in line with your notion of higher productivity, is change of social organization. We all know that social organization can affect quite a lot the way our standard of living. For example, we spend 4 hours traveling to work. If we had changed the social organization, we perhaps spend half an hour one way. And another question is, would the world, not just the West, be thinking very hard about working less hours? I mean, we have been working 5 days a week since the 1960s, and things have advanced, productivity and whatever have advanced so much in the past 50 years. So isn't it time for the world to think that at least for a good share of the economy, for people to work maybe 4 days a week, and I hope to work 3 days a week? Thank you.
Going back to your last question first, I think in some cases the US has taken this to extreme of working no days a week. But there's a slight sort of dichotomy there, isn't there, between the idea of taking lower wages, but at the same time the idea of working fewer hours. In other words, that if you work fewer hours per week, it's probably the case that unit labour costs, unit wage costs will probably go up in those circumstances, whereas if you're hoping to get more competitive, you might have to work more hours per week rather than fewer hours per week. But let me take your first point, the economic rent story, the idea that Western workers were living not so much beyond their means, but at a market price which is above the global market clearing price. I think this is actually a reality, but I don't think it will necessarily come through via cuts in wages. I think it will come through via the idea that perhaps the West's growth rates in the future will not be as strong as they have been in the past. That because asset markets in particular priced in very strong growth in the future and basically got it wrong, those asset markets will come down in value. So people won't necessarily receive wage losses, but they might receive wealth losses. In other words, the paper wealth that's measured currently may diminish over time. And so people will feel worse off. And of course, the classic example of this is Japan over the last 20 years, where wages have held up reasonably well, but wealth has come down because of declines in land prices and declines coming through in equity prices as well. So if the West is worse off, it may not be through wages, it may be through assets, because in effect, asset markets are priced for much higher growth than perhaps will be delivered in the years ahead. As for social organization, yes, in fact, I remember writing a paper back in 1990 in defense of the Japanese growth model, because there was a big story about demographics at the time, quite rightly. I said there's a way of solving this, which is just to get more women into work in Japan. And in fact, the numbers suggested that if that had happened in a sizable way, then actually you might have seen part of the demographic pressure being alleviated. But it didn't really happen, either because women didn't go to work, or alternatively because when they did go to work, they weren't given the jobs that their education would perhaps have deserved. So there were social constraints, arguably, on Japanese growth, which were related to social organization. In the West, you've seen, obviously, some changes coming through, like, for example, the provision of creches, the flexibility of people's work weeks, the ability to take time off from time to time. HSBC, for example, was kind enough to give me 3 months off to write the book, so I was scribbling extremely frantically to try and write the thing. But yeah, there is more flexibility beginning to come through, which is better. But I'm not sure we quite got to the point of having a proper debate about all of this.
If I could just slip in one quick question, then I'll turn to these two questions. You've referred on several occasions to the terms of trade. In the last maybe decade or so, you could argue that the US consumer benefited from a very favorable terms of trade gain and low real interest rates given Chinese savings in particular. Looking forward, the story you tell is one where presumably the big gainers are the commodity producers and at this stage in terms of technology, the oil producers. You get an ambiguous effect for the rich countries because consumer goods are cheaper, commodities are more expensive. But isn't it the emerging markets that lose? Because if they grow very rapidly, the terms of trade moves against them dramatically.
Yes, of course, it depends on what you mean by the emerging market, because the emerging markets include many of the commodity producers. So,
But
for the China, well, of course, part of the problem here is the causality. That the causality is that China is doing well, arguably, at, say, the West's expense, because it's becoming increasingly productive, supply-side improvements coming through, skills and so on are continuously rising. And arguably, therefore, the Chinese are able to pay more and more for their commodities. Although it's in terms of trade deterioration in terms of commodity prices, it doesn't stop the Chinese model from continuing to expand. But certainly, in fact, already I would argue, there's evidence of this terms of trade shift taking place, which has been detrimental to the West. And the way to think about this, I think, is to go back 5 or 6 years, maybe 7 years, when oil prices were $20 a barrel. And imagine that we'd had this discussion back then, and I had predicted with some degree of remarkable accuracy that there would be the deepest Western recession since the 1930s. I stress that I wasn't predicting that, but I'd like you to believe that I was predicting that, because that would make me look cleverer than I really am. And the point about this is that if I predicted this, then we had a discussion about the implications for oil prices of the West having this very deep Western recession. My guess is that people might have said, well, we're going to end up with oil prices falling from $20 a barrel currently down to $5 or $10 or $15 a barrel. But no one would have said they'll be up at $70 or $80 a barrel, which is where they have been over the course of the last few months. The reason why they wouldn't have said this is because they wouldn't perhaps have recognized the increased buying power of China and other nations in terms of commodity prices and oil prices in particular. And one consequence of this is that in the past, when the West had a recession, commodity prices would collapse. And the collapse in commodity prices would mean that the West would export its recession to other parts of the world, who would suddenly find themselves with terrible terms of trade loss, suddenly find themselves with collapsing export earnings, and you end up with things like the Latin American debt crisis. This time around, it hasn't happened. The US and Europe have not been able to export their recession via collapsing commodity prices, and that may be one reason why actually the US and Europe have struggled to recover. It's associated with the rise of China, the impact of the rise of China on commodity prices, and the loss of a safety valve that has been quite important in the past. The other thing, I just briefly add, if I may, is that this terms of trade story, this relative price story, is really important from a political point of view, I think, because it leads to, I think, an ambivalence about globalization. I can give you a very simple example. Imagine you're an American woman, you work in a manufacturing company, and you pay partly in wages, partly in shares. You drive to work in a gas-guzzling SUV, and you happen to love watching television. You bought lots of flat-screen TVs to put all over your house. Are you a winner or a loser from globalization? Well, as a wage earner, you're probably a loser. As a shareholder, you're probably a winner. As the driver of a gas-guzzling car, you're probably a loser. And as a consumer of TV programs and flat-screen TVs, you're a winner. Are you overall a winner or a loser? You don't know. You're really unsure. And it's that ambivalence, I think, that actually leads to some of the opposition to globalization that's been building in the West over the last few years.
Thank you. There were two questions from here.
Thank you. My question is, just now you say that the U.S. have a misbehavior to sell large amounts of treasury to the rest of the world, to China. But I'm from China. I'm an MP program students. And my question is, do you think it's also a misbehavior of the Chinese government to buy such a large number of U.S. Treasury bonds? And do you think there's any possible negative impact on the life of the common people? And in which way our foreign currency reserves can be better managed?
Well, let me say that this all could end in tears in one way or another. It's like a sort of a merry-go-round that spins faster and faster and faster. and it's fine while you're on it, but eventually the whole mechanism will collapse and will come falling down. Part of the issue here, of course, is what does it really mean for China to accept paper losses on treasuries? It's not entirely clear what would be meant, because it's not clear that the Chinese people directly currently are benefiting from these holdings of treasuries. However, what you might say is that China is still benefiting in other ways. Going back to my Spanish example, if you like, the cost is the acquisition of treasuries, and the cost, therefore, is also the fact that you have risks on those treasuries for the future associated with the exchange rate. The benefit is that because the US is living beyond its means, China is able to ramp up its production to expand its economy faster than might otherwise have been the case. So there's a sort of trade-off in those terms. In terms of an exit strategy for China, first of all, this is not sustainable. It can't go on forever. And there are a number of different exit strategies. The first one is this. Let's imagine that the West has another crisis in a year's time. Not impossible to imagine. And let's imagine that that crisis involves another banking crisis. The banks are in difficulty, need some kind of government bailout. But government deficits now are up at 10, 11, 12% of GDP. Debt-GDP ratios are rising incredibly quickly. If I was China, I would say, I'm not going to buy your treasuries to allow you to fund your own bailout of your banks. I'll buy your banks. In other words, that if the US wants to continue living beyond its means, the sensible thing for China to do would be to demand, at a time of US weakness, that it buys real assets rather than paper assets. Now, of course, whether that's politically acceptable is extremely debatable. But if the US becomes desperate, if the alternative to Chinese intervention is that the banks shut down together, you might just say, well, it's a price that's worth paying. So that's one thing that might change, not because of China's changing policy, but changing policy in the States. And the other change comes back to the reserve currency story, which is that if it turns out that China and others reject the dollar, and you end up with huge paper losses on treasuries and so on, yes, there's a cost to China. On the other hand, if China could engineer a world whereby its own currency is being treated as a reserve currency, then there's a benefit. And the benefit, of course, will be lower access to capital, lower cost of capital, shall I say, in the future, together with a lower cost of doing trade. And interestingly, we look at China's negotiations with countries in parts of the emerging world. At the state level, increasingly, we're seeing negotiations where the trade is being done in renminbi rather than dollars. This is very, very early days, but 20 or 30 years down the road, you can just about imagine that the renminbi becomes a reserve currency and brings to China some of the benefits that America itself has enjoyed over the last few years.
Thanks. And yet we live in an ironic world where the debtor dictates to the creditor which assets the creditor can buy. We have a question here.
Yeah, thank you. My name is Jan. I'm a PhD student here for public policy. Firstly, I appreciate there are different opinions on the euro and HSBC. That's interesting. My question is a bit to your notion of the West. You're generalizing here, of course, and the West is, of course, also diverse. I was wondering if you have an opinion or some views on the question if the West also should integrate further or get closer together, Europe and the US maybe, but also maybe inside of Europe, would it help to go further on European integration, further enlargement to Turkey, spreading the euro across Europe, so at least to prolong this dilemma potentially?
Let me deal with the question of Turkey. I think one of the advantages that the euro has relative to the dollar is that when countries join the euro, they get voting rights. Whereas if you're a country that chooses to peg yourself against the dollar, you don't get a seat in the FOMC in Washington. You accept the policy, whatever it is. If it works for you, it works for you. If it doesn't work for you, that's just tough. So in one sense, the euro offers a more, if you like, a democratic process than is the case from the point of view of the dollar bloc around the world. I do think there's a possibility that the euro widens either eastwards or possibly even southwards. Imagine, if you think about the Roman Empire after it went across North Africa and the Middle East as well as Europe. And I'm maybe letting my imagination run rather too wild at this stage. But it does strike me that the euro has these strengths of allowing membership to broaden and allowing the members themselves to have representation, which I think is important. As far as relations with the US are concerned, I don't know. I think that the US, in its foreign policy, is increasingly looking westwards rather than eastwards, and southwards rather than eastwards. it sees its future connections perhaps more with Latin America and more with Asia than with Europe. Lots of reasons for thinking that. Asia is much more dynamic. Europe is sort of stuck in the mud. Europe's got aging populations, which are not going to be a source of future demand. Asia has all sorts of important strategic relationships that perhaps Europe won't carry in the future. So I'm not sure that the US and Europe would necessarily make particularly happy bedfellows. The UK likes to think of a special relationship, but that's more a figment of Britain's imagination than anything else, I would suggest. So that'd be my answer to your question, I think.
Okay, well, look, unfortunately, we're going to have to bring things to a close. I always find it interesting when a national of the UK is asked about the euro. I think, one issue looking forward on the euro and the role or potential role of future reserve currencies is that the euro, in a sense, is a stateless currency. There's no single government that stands behind it. And traditionally, we've had single governments standing behind reserve currencies. And I think that creates an element for the euro that's a little bit different. I mean, the joke used to be in a currency crisis, what numbers do you call? Germany, France? It makes it a little bit difficult. But look, you've given us a lot of food for thought. As a sign of my appreciation, let me remind everybody that it's all there in writing in this book, the issue of losing control, the emerging threats to Western prosperity. So thanks very much, Stephen. And I think you convinced us that this is quite different to the Stephen King horror stories. And I guess we have to figure out which block we're in to figure out whether we see it as a happy ending, a modest ending, or an ending with tears. Thanks very much.